How's it going today? Today we're going to talk about, is the S&P in a bubble? I get this a lot. Everybody says it's in a bubble, and I get tired of hearing it. So I'm going to make a video. So essentially, I'm going to give you the information. Is it in a bubble? My opinions about it. I give you a lot of data and everything like that. That's important, and evaluation levels and all this. So essentially, is it in a bubble? Yes, no, depends how you look at it. Anyway, let's do some comparison to it. I'm going to compare it to 2007, 2000, and then I'll compare it back to the 90s, the 70s, and 1980s. So essentially, is it in a bubble? Let's look at the PE ratio. The PE ratios is basically price to earnings multiple that states that, and states why is it good, why is it bad. I gotta give you all the information that you need on that. Basically, it's the price to earnings. Basically, it's like a multiple. So essentially, that's what it is. So, on an average, they say around between 20 and 10 is kind of fair value. I mean, it depends on the growth. I mean, it doesn't calculate growth. So essentially, some PEs like Amazon could be up in the 70s and actually be undervalued, depending on the cash flow. If it has a lot of cash flow, the business is worth more, or it's growing. So essentially, but getting into the S&P, let's look at the numbers with that. With 2000, the PE was up at 33. So essentially, a high PE, but in 2007, it was at 15. So really, the S&P wasn't really in a bubble in 2007, but it crashed heavily. So does it really need to be in a bubble? I mean, no. I mean, was the housing market in a bubble? Did it bleed over? That's really what kind of happened. The housing bubble kind of burst. And what is a bubble? I mean, let's say an asset prices go up a lot. It's only a bubble in hindsight. Nobody knows you're in really a bubble until it pops. So essentially, you can look at Amazon. I mean, it can just be in a bubble, but if it doesn't pop, is it really a bubble? I mean, let's say it just kind of keeps going up and keeps growing, and it kind of pauses. The bubble may not even pop, and it just keep going. I mean, with a lot of stocks, the stocks always seem like in a bubble, but they just keep going on for decades. I mean, how long do these bubbles last? Is it in a bubble if it doesn't pop? So that's what you have to ask yourself, when they're talking about these bubbles. I mean, it could be in a bubble or could not be in a bubble. And there's some cases where the stock market is actually undervalued. I could get into these things and it never pop. But PE ratio, it looks like it's going to pop, but it actually, but anyway, and the PE ratio of the day is around 21. So essentially, you look at every single year. So we're not in a bubble. 21 PE. I mean, that's not bubble stage. That's not .com bubble, which is at 33. But here's where the PE just goes out the window, because the PE in 2002, that's the bottom of the market, is at 41. So you're in more of a bubble. I mean, you're paying more for earnings. In 2009, this is really just kind of blows it away. The PE is at 48 of the S&P. So why is that? Why? So why you wouldn't even touch stocks in 2000, and that's in January, and we bottomed in March in 2009. So we're in a bubble then by the PE ratio. But PE doesn't really. It's just a quick multiple. It doesn't really, maybe because earnings dropped a lot, because sales dropped, because you're in a recession, everything slows down, and sales drop. So how do you know? Okay, and here's the other thing: the bond yields matter too. So you have to look at the bonds. So let's look at 2000. The 2000 bond rate on the 10-year is at 6%. So really, that's how you really kind of evaluate these companies. I mean, why would you buy a company if a company has 10% growth or a projected 10% growth, and you can get a 6% on yield? I mean, that's an okay business. But let's say a business growing at 6% and your expected return is 6%, but a treasury bond is 6. I mean, that's really a subpar business. I mean, why would you put your money at risk when you get a 10% yield? And as you can see, so really, were stocks a lot more? I mean, you would have to be growing a heck of a lot. So that's why really the .com bubble really was in a big bubble, because you're expecting at least 6%. If you're buying a stock, you have to at least get 6%. And if you're not, then you're just kind of throwing away money. You know, you're not getting a very good, I mean, why would you buy a company to get less than 6% if you get a bond? But let's say 2007 bond, 10-year bond was at 5%. I mean, so essentially you can get 5%. But now look at today's center. In 2019, bonds are at 1.76%. So, I mean, that is actually less than inflation. So even if you bought bonds, it's less. You're actually losing money. Actually, your real return is basically your return, then subtract inflation. So you're losing money if you buy bonds in today's world. So essentially, that's why everybody's pouring in stocks, because it's the only investment really in town. And really, the PE ratio is at 21. So you can see why people would pay more for stocks in today's market. You know, and let's look at the now this is, so you can look at that. Are we in a bubble? I mean, you know, I mean, it's debatable. I mean, nobody really knows. So when someone says they 100% know because the PE ratio is too high, well, in 2007, I mean, the PE ratio was only 17. And then in 2009, we're in a bubble because PE is 48, you know, it's going to go a lot lower, you know. But, you know, at 48. But now there's another indicator they always look at. It's called the Buffett Index. I mean, it's named after him because he uses it. He says the most accurate way to tell if it's roughly overvalued or not. Basically, what it is the total market value divided by, you know, the GDP of America. So essentially, and that will give you the kind of the Buffett indicator. It'd be in percentage, and 100% is fair, is what he calls a good market value. Anything below is undervalued. Anything above is overvalued. So in the 2000s, the Buffett indicator was at 160%. I mean, that's, see, by him, it's overvalued. And then in 2000, the Buffett indicator was at 120. So it was overvalued. And in 2019, today, it's at 140. But so by that indicator, it's overvalued. But here's where it gets contradicting. Because in 1987, there was a big crash. You can look it up, type in stock market crash, 1987. And what was the Buffett indicator then? It was 60. So if it was a bubble leading up and the market went extremely high in 1960, in 1987, and you would say we're not in a bubble because stocks are relatively cheap, then why did it crash? You know, so really, and then you could say, well, there wasn't a recession, it was a lot of other things, and yeah, so really, there's no indicator that's 100% right 100% of the time. And then you look at the Buffett indicator in 1970, 1969, that area around there, that was leading into a recession. The Buffett indicator was 80. So stocks were not in a bubble. But they still crashed. They still lost 50% of their value in the next 3 years. I mean, 1973, 1974 was a horrible recession. It was the oil thing, and stocks got hammered. So, I mean, it's not, so when you say it's in a bubble, by really what indicator? You know what I mean? Would you pay more for stocks if bonds were horrible? Yeah, I mean, that would make sense. And now you can look at the Buffett indicator, but it doesn't really, you know, do a lot. So that's the only thing you can say stocks are in a bubble, you know, is the Buffett indicator. That's the only thing that's really saying we're in a bubble. So, but let's say it pops, and let's say Buffett is right, and it goes down to 100. If it went down to 100, that'd be fair value. So the S&P would sit around 2,000. I mean, that's where it would sit at. Is around 2,000. So that would be going back to 2015, 2016 levels. So it would only go back 3 years. I mean, so that's that. I mean, according to that indicator. I mean, so if you draw the conclusion, are we in that big of a bubble? So when someone says we're in the biggest bubble of all time, we're going to explode and then go down 50, 60, 70%, don't listen to them, because on what basis? You know what I mean? That's speculating that the world's going to come to an end and everybody's going to lose everything. And that just, I mean, will it happen? God only knows. I mean, you're trying to predict, and there's no indicator, like I said, that predicted any of these. You know, with the bonds, you know, being that much, the PE ratios, I mean, they're kind of off. So, that's really, is it in a bubble? Who knows? It's almost to the point. Even, and the other thing is, let's say in the 90s, if you would buy Amazon, it went all the way to 100. Was it in a bubble? Yeah. Was it a bad investment if you bought it at 100? No, I mean, it went up 20 times since then, while the markets only went up about 100. 100%. You know, so you double. So you put 10,000, you're sitting on 200,000. So, in my opinion, that's why you don't try to time the market. You just find good businesses and hold on to them. Because but it did drop. Amazon did drop about 90%. It did lose a lot of its value, but it kept going, and now it's hitting all-time highs and doing well. I mean, so does anybody know? No. Is there one indicator that tells you what stocks are doing in this? I mean, no. I mean, there's no really indicator that we're heavily in a bubble. Like I said, even with the Buffett indicator, I mean, that could be only 2,000. I mean, that's only maybe a 30% drop from where we're at now. I mean, if we keep going on for years and years and years, but GDP will slowly go up. So essentially, if the market kind of just sits here for a little bit at 3,000, the GDP will go up. So essentially, the overvaluation will go down. But anyway, that's all I got to say for this video. Leave a comment. See what you have to say about it. You know, I mean, everybody has their own little viewpoint. Maybe a little whatever. Make sure you subscribe. I'll go do daily. I'll go pick some more stocks this month coming up. But thank you for watching. Thank you. Have a good day.